Can you guys see that okay?
Yes.
Mhm. Got one more that's loading here. Not sure why that one won't join, but we're going to go ahead and get started. All right. Good afternoon, everyone, and thank you all for joining us for today's A Month of Service presentation of Foreclosure Series. Today's presentation is about mortgage foreclosures, home equity loans, and reverse mortgage foreclosures. My name is Nia Murray. I am the programs coordinator with Neighborhood Recovery Community Development Corporation. We are one of the partners in the A Month of Service collaboration. Also included is the City of Houston's Department of Neighborhoods. And presenting on behalf of our partners with Lone Star Legal Aid, today we have Ms. Lauren Masulo Martin and Ms. Samantha Guzman, who's going to be providing the information for you today about foreclosures. Also included in our collaboration is the Earl Carl Institute, the Harris Central Appraisal District, Texas Legal Services Center, Harris County Tax Assessor Collector's Office, Houston Volunteer Lawyers, and the Harris County Attorney's Office. And together we make up a month of service. And basically, a month of service is the collaboration of all of our organizations coming together on a bi-monthly basis now. Or is that right? Bi-monthly, every other month now. We used to be monthly, but now it's every other month, offering a variety of different workshops and resources and information to the communities that we all serve relative to asset protection, asset building, preservation of generational wealth, and community empowerment. We decided several years ago to collaborate in an effort to reach more people, to create a larger impact, and to try to get as much information out to the community as we possibly can. For those communities that are underserved, that do not have access to a lot of resources, that don't know where to go for available services that are out there that are for free or at a low cost. Um, we decided to collectively kind of pool a lot of our resources together, a lot of our initiatives, and provide them in a collaborative effort again to try to reach more people and to create a larger impact. So we want to thank you all for joining us this afternoon. Do note that the information that does get provided on any of our presentations are not to be considered legal advice. However, it is for educational purposes only. We do encourage you, however, to reach out to our legal service partners if you do find yourself in need of any civil legal assistance. And Lauren and Samantha will go over some of the other services that are offered through Lone Star Legal Aid as well. But again, this is your opportunity to ask whatever questions that it is that you may have. We do ask that you try to keep your questions to be as general as you possibly can, as to not divulge any personal or detailed specific information, as we are on a public platform and we do record the sessions. We want to try to protect your privacy as best as we possibly can. So don't give us, your name, you live at, this is your personal experience with foreclosure or what you're going through. So we don't want all that information kind of getting out there for everybody to have access to. But again, please feel free to type your question into the chat if you're joining us on Zoom. If you are joining us on our social media platforms, please feel free to type your questions into the comment section. And I am monitoring that, so I will be able to read those questions aloud at the end of the presentation to make sure that those questions are addressed, and answered for you. So I think that's just about it. We're going to go ahead and move on into the presentations. Oh, and again, with the foreclosure series, it's actually done in three parts because we know that there's different types of foreclosures. There, we decided to break it up into several sections. So this particular session is about mortgage, home equity loans, and reverse mortgage foreclosures. We've also have sessions on HOA foreclosures as well as property tax foreclosure. If you guys have any questions or any issues related to those, then please reach out to me and let me know, and I'll be happy to send you the recording of those previously sessions for those other kinds of foreclosures if you have questions about that, or if you know of someone who may be in need or needs some assistance about those types of foreclosures. But today, for today's purposes, we are only talking about mortgage, home equity, and reverse mortgage foreclosures. So, with that being said, I'm going to turn it on over to Samantha and Lauren and have them introduce themselves, and we're going to go ahead and get started with the presentation. So, um, go right ahead.
Hello, my name is Lauren Masula-Martin. I'm the managing attorney of the Foreclosure Prevention Project here at Lone Star Legal Aid. I've been with the firm since about 2016 and in this project since about 2018. We are so grateful to be able to work with AMOS and all the community partners to provide this information. So thank you very much. And I'll pass it to Sam.
Hi, everybody. My name is Samantha Guzman, and I am a paralegal here in our foreclosure prevention unit. I work alongside with Lauren. And so let's jump right into this. So I'll start sharing my screen. Okay. Oops. Okay, so today's presentation is again about mortgage foreclosures. As a reminder, today's presentation provides legal information only. It is not legal advice. We cannot tell you what type of mortgage loan or loss mitigation option is best for you, and that you should please consult your financial or tax advisor and or lawyer for advice regarding your personal situation. Our agenda for today is I will give you just some brief information about Lone Star Legal Aid. Then we'll talk about mortgage foreclosures generally, followed by loss mitigation, including successors and heir property, and then the specific types of mortgages. And then at the end, we'll have a follow-up question and answer session. So here at Lone Star Legal Aid, we protect and advance the civil legal rights of the millions of Texans living in poverty. We serve about 76 counties by providing free advocacy, legal representation, and community education that ensures equal access to justice. Some fast facts about Lone Star Legal Aid. We serve about 60,000 square miles across 72 Texas counties and 4 in Southwest Arkansas. Our staff operates from the Houston office where Lauren and I are currently in, as well as 10 other offices. We serve, nearly 2 million people in the service area who qualify for help based on federal poverty guidelines. In 2024, Lone Star Legal Aid handled over 25,000 cases, assisting over 61,000 people, many of whom were survivors of domestic violence or seniors and or veterans. So who do we help at Lone Star Legal Aid? We help some of the most vulnerable members of our community, including children, veterans, seniors, people with disabilities, members of the LGBTQIA+ community, and individuals who are experiencing homelessness. The majority of our clients are women, and many of them are mothers trying to care for their families. A lot of the people that we serve live in rural or remote areas, and they may face isolation because of limited literacy or language barriers. And many don't have reliable access to, excuse me, the internet or even phones. In fact, more than 1.5 million people in our service area speak a language other than English at home. So language access is a big part of our work. The need for legal help is far greater than the number of attorneys available. In Texas, there's one attorney for every 380 people in the general population. But in our legal aid service area, remember, this is our 76 counties, there is only one legal aid attorney for every 17,000 eligible low-income residents. And finally, many of our clients, again, don't have access to basic communication tools like phones or computers. And public transportation is where most of the rural areas we cover, making it even harder for these people to get help. Again, our mission at Lone Star Legal Aid is to protect and advance the civil legal rights of the millions of Texans living in poverty by providing free advocacy, legal representation, and community education that ensures equal access to justice. So we're going to talk this one little slide about eligibility. Again, you have to reside in one of the 76 counties we serve. We only work on civil cases and do not handle criminal cases, and we only serve those who are low income. So there are some financial requirements that you have to meet to be eligible for our services. Some substantive law types that we work on, again, anything civil, mostly anything civil, including consumer law, employment law, family law, healthcare issues, housing, juvenile issues, neighborhood problems, public education, and financial assistance and public benefits. So think SNAP benefits, Medicare, disability, that good stuff. And then we have our special projects here at Lone Star Legal Aid, and they do include Civil Matters and Criminal Justice Project. We have our Community Advocacy Unit. We have our Crime Victims Unit, as well as our Disaster Relief, and our Low Income Taxpayer Unit, our Medical Legal Partnership unit, as well as our Legal Assistance to Survivors of Sexual Assault Project, which is also called LASA. Then we have our eviction right to counsel, our fair housing unit, our military and veterans unit, and then of course, last but not least, the best foreclosure prevention project. So you might ask yourself, how do I ask for help at Lone Star Legal Aid? Well, you can always apply online 24 hours a day, 7 days a week by visiting www.lonestarlegal.org. Again, that is www.lonestarlegal.org. If you do not have internet access to the internet, you can give us a call at 1-800-733-8394, Monday through Friday during regular business hours. Again, that number is 1-800-733-8394. Again, Monday through Friday during regular business hours. If you are asked to leave a voicemail, please leave a voicemail detailed with your contact information and somebody will call you back. You can also follow us on social media. All of our handles are at Lone Star Legal Aid, and we are on Instagram, Facebook, and YouTube. Now, with that being said, I'll go ahead and I'll turn this over to Miss Lauren, and I'll see y'all in a bit.
Great. Thank you so
Bye.
much, Sam, for covering all that great information and telling everyone how they can get some help. Now, let me see if I have the technology down to be able to share my screen. Let's see here. Okay, we should have that. And then,
Still loading.
okay. And then, okay. Hopefully you have the information there. Is that showing right?
Did you open the, yep, that's it.
Okay, great. Thank you. First hurdle overcome. Okay, thank you again, Sam, for your help and your presentation. And now we'll go into information about mortgages and mortgage foreclosures. So we'll start with just a basic kind of overview and definitions. So there are several different types of mortgages. I think most of the time when someone says you have a mortgage, you're thinking of a traditional, what they might call a forward or a purchase money mortgage. You get a mortgage so that you can buy your house. But there are also other types. There's a reverse mortgage, which is a special loan product just for the elderly, where you're kind of tapping into the equity in your home and it gets paid off at the end. We'll talk about that. There's deferred balances or partial claim liens. There's different ways that when people get behind on their mortgage, they end up taking a portion of that amount that's owed and sticking it at the end, so to speak, and it's kind of like its own little mortgage. There's home equity loans and home equity lines of credit, which we'll talk about briefly today. There's something called a seller finance executory contract. Sam will be joining us again to discuss that, where somebody is buying something from a private seller usually. And then something you might have started to hear about called zombie second mortgages, or basically people had a mortgage in maybe one of these second ones in the back that we referenced above, and suddenly they thought it was paid off or cleared up in a bankruptcy, or they paid off their main loan, and they thought that second loan was included and it wasn't, and it pops up. And a new one we're even seeing, which isn't on this slide, is shared equity agreements, which is something new. We don't have any presentation on that yet, but people kind of agreeing to share their equity in the home, and those can be pretty predatory actually. So today we're going to be focusing on the forward or traditional mortgage, a reverse mortgages, and we will talk a little bit about home equity loans and home equity lines of credit. Okay. And then what is mortgage foreclosure? So a mortgage places a lien on a borrower's home. So a lien is basically a legal right to um, sell the home or take the home to satisfy the debt or the amount owed on the mortgage if it isn't being paid, or if you're not meeting the requirements of your contract, your mortgage contract, your loan requirements. A lien is also an obligation to pay a debt that can be enforced by selling or foreclosing on the home. And one thing to keep in mind in a foreclosure sale is usually it's going to sell for bottom dollar. They only sell for, or they start the bidding at however much is owed. So oftentimes homes sell for less than the market value, and you can lose the equity in your home. So as a very last resort, if somebody is facing a foreclosure, if you can at least try to sell on the open market and tap into the full market value of your home, that's always preferred over going into a foreclosure if you can. Okay, and who are the main players, so to speak, in the mortgage landscape? The first one that we'll talk about is the owner or the investor or the insurer. You might hear different terms, but basically it's the entity that finances the loan, that the one that lent out the money and that's owed the money to be paid. It determines what loss mitigation options are available. So that's a term of art we'll talk about later in the presentation. Loss mitigation is what do you do to get back in good standing with your mortgage company if you've gotten behind on your bills. So this entity determines what your options are to get back in good standing if you can't pay. There are federal and private owners of loans. So a federal backed entity, one where the government is maybe insuring things or regulating things. You might have heard of Fannie Mae, Freddie Mac, or Ginnie Mae. These are government sponsored enterprises or GSEs. Then there's FHA, Federal Housing Administration, which is a department of HUD, Housing and Urban Development. There's also the Veterans Administration or VA. You might have heard of VA loans. And then there's the Rural Housing Service, part of the USDA, and they have both direct loans where you're actually paying the USDA, the government, or guaranteed loans where a different entity owns it, but they're insuring it. So those are all the federal backed ones, and they have details about and regulations and publications and guidelines about what can be done to get back in good standing with your mortgage. The other option is it's a private entity. It might be a bank or a trust or something like that. You might hear the term private label security or portfolio, some private entity. And those are the ones where they also could offer loss mitigation options. It's just a little harder to find out what your options are, but you should still have some. The next entity is the loan servicer. So that's the agent of the investor. So if, trust number 123 is the one that is, the investor on the loan that owns the loan that the money's owed to, the operators are going to hire an agent or an entity to actually interface with you. That's the company that you are talking to when you call your mortgage company and ask questions. They're the ones sending you the mortgage statement. They're the ones that you mail, when you mail your payment in or now pay it online or what have you. They're the ones you're paying. They're the ones who keep track of everything. The borrowers must work with the loan servicer when trying to get out of default and do loss mitigation, trying to get back in good standing if they're behind. So even though that entity is the one that determines what's allowed to be done, it tells the servicer, okay, this is what you're allowed to offer. And then the servicer is the entity that's saying, okay, send me your fill out this form or whatever to get your mortgage back in good standing. And some quick notes about investors and servicers. So investors, the entity that is owed the money can sell from one to another. You really don't get a choice. And that investor picks the loan servicer, and if it changes, you don't get a choice in that either. You should get a letter telling you to start sending your new servicer monthly payments, but we do see servicing transfer confusion. Somebody's been sending their mortgage payments to the servicer they've had for years and don't realize they need to send it to a new one. So if you do have a mortgage and get a letter saying, starting next month, you have to pay this other entity, double check, but it's probably a servicing transfer. Occasionally, the servicer is the same as the investor. Sometimes they do keep that service in-house, usually if it's like a big bank or something, but it's not uncommon that they're two separate entities. Okay, and now we'll talk a little bit in general about mortgage foreclosures, just kind of general concepts. So in order to foreclose on a loan, the borrower must default, meaning the borrower doesn't keep up with their terms of the mortgage, most commonly that they haven't been paying the mortgage. As we'll talk about with reverse mortgages, maybe they haven't been paying their taxes or something like that, or keeping their homeowner's insurance. That's an issue as well. So the term loss mitigation is the industry term for what do you do to get back in good standing and get caught up again so that you can avoid that foreclosure. And what are some reasons that borrowers default? Well, first, the high cost loan. You may have taken out a loan thinking you could afford it and something changes along the way, or maybe there was a variable interest rate and you got a really good loan amount to begin with, and now it starts raising. Another thing, of course, life happens, so people might lose a job or be impacted by disaster or divorce or passing of someone in the home, changes in income, and that can result in a default because of difficulty paying the mortgage. Also, on the flip side, maybe income hasn't been lost, but expenses increase, like someone got injured or illness, need to pay medical expenses, something like that. And then with reverse mortgages, again, a special entity, you pay your property taxes and homeowners separately. Usually in all the other mortgages, you're paying a bit every month, and the servicer is paying using your money to pay the taxes and insurance. But with reverse mortgages, you do that on your own, and sometimes people get confused about that. Regarding mortgage foreclosure generally, so Texas is what's called a non-judicial foreclosure state or non-judge. Oftentimes, homes can be foreclosed without a lawsuit. So this applies with mortgages. We have other presentation on taxes and HOAs where there sometimes are lawsuits or may be required for lawsuits, but with mortgages, only specific circumstances require lawsuits. Often they just have to sell it with particular notices. Foreclosures in Texas are always the first Tuesday of every month. That only changes if the 4th of July or New Year's Day falls on a Tuesday, and then it goes to the next day. But as a tip, if someone's getting a notice in the mail that says, you have to pay this by the 20th or something, that's probably not a notice saying that this property is set for foreclosure. But if you get a notice that says something's happening on the first Tuesday of a month, then that's usually a foreclosure sale notice. And it should say notice of sale and so forth on it. Under federal law, a loan servicer can't send the first foreclosure notice or file a lawsuit until the loan is 120 days in arrears, delinquent. Now, for that means the actual notice setting in Texas, that means the notice setting the sale date. So you're going to be getting notices and letters well before the 120 days is out, but that actual we've set it for sale you have to be 120 days behind. When you're behind, the servicer needs to send you a letter, a notice of default, giving you at least 20 days to fix the default. And the term default means whatever's gone wrong. So if you don't have insurance, you got 20 days to get your homeowner's insurance. If you haven't made a couple mortgage payments, you have 20 days to go ahead and get those payments done. Some of them choose to give 30 days or longer, but that's the minimum. If you don't fix that problem, that's when the loan servicer can do something called accelerating. That means the whole loan is due, the whole 100,000 or whatever it is. And that's when they either file a lawsuit, or most often with mortgages, just set the property for sale. That's when you're getting that notice that has to be sent 21 days before the sale. And just as an aside, if you do get foreclosed on, you have to actually, most cases, the buyer actually has to file an eviction lawsuit. There's a few exemptions with taxes, but for the most part, the buyer has to file an eviction lawsuit. So I went into some of this. 21-day sale, notice of sale. Let's see, with a reverse mortgage, there is kind of a two separate types of processes. If the last borrower passes away, if the reason for the default is simply that the borrower has passed away, then with a reverse mortgage, they can just set it for sale. Otherwise, they do have to try to reach the heirs first, the people who would have inherited. If it's any other type of default, they do have to file a lawsuit. Okay. Judicial foreclosure, just mentioning there are cases where they have to file a lawsuit, like those reverse mortgage where it's not a death of a borrower issue or a home equity loan. But one thing to keep in mind is even when a lawsuit is required in Texas, Texas has an expedited process for mortgages, which means when you typically get sued, it can take a really long time. Maybe with a regular lawsuit, they have to get you served by constable or something. You have some time before trial, but with foreclosures, they're allowed to file an expedited suit. All they have to do is mail you a letter, 38 days to respond, which is a unique amount. Within 38 days, you have to file something with the court saying, that you're there and something has been done wrong. Otherwise, they're allowed to just get an order allowing them to foreclose. So even though it's a lawsuit, it's a very quick one. With reverse mortgages, again, the most common is when the taxes, HOA, or insurance aren't paid. And again, even if a lawsuit was involved, they still have to send that 21-day notice of the foreclosure before they actually set it for sale. One comment here to avoid scams. So that 21-day notice that foreclosure is scheduled actually gets filed with the county clerk. And of course, if a lawsuit is filed, that gets filed with the county or district clerk as well. And so then the public knows that this house is at risk of foreclosure, and scammers may start contacting you, sending letters. Don't be pressured. Don't feel they may say, just sign the house over to us and we'll pay and then we'll give it back. It sounds good, too good to be true. It probably is. The Federal Trade Commission has a great article on mortgage scams, consumer.ftc.gov. You can search for that. You can contact a HUD housing counselor. Call 211, the United Way hotline, and ask where can you find a HUD housing counselor. You can also go to HUD.gov. They actually certify people who can look at your circumstances and give you, assessment and maybe some assistance. Here are some examples of scams. Phony counseling. The scammer, again, pretends to be some kind of negotiator who can talk with the lender on your behalf. Maybe they even charge you, when all of this should be free. Your right to talk to your mortgage servicer, to apply for loss mitigation, all of that is free. So anyone charging you for it is suspicious. Rent to buy, they say sign the deed over to me and, you can rent it from me, or I'll sign something giving it back to you, and it turns out to be a rent agreement. And, equity skimming, where they convince the person to just sell them the house at much, much less than it's worth. And heir property owners, meaning people who inherited the home because the primary owner or borrower passed away, those people are often targeted. And we're going to talk a little bit about heir property shortly. So loss mitigation, this term that I've been discussing. Again, it's a process of working with your loan servicer to avoid foreclosure, cure a default. There are generally two types of them. Home retention is what can be done to retain or keep the home, paying back your amount owed or renegotiating the terms of the loan so that you can, afford it now or some combination. And then there's non-home retention or graceful exit options where you don't go through foreclosure, but perhaps you can at least keep the equity in your home, like sell it on the market for fair price, and avoid scammers and that kind of thing. So the options vary based on the type of loan, the investor, and the borrower eligibility. So if somebody has a lot of income or if they don't, that kind of thing. Options may include one or more of the following. Reinstatement is generally if someone can afford to just pay the whole amount off and then go back to square one, just the way things were before. Forbearance means that the mortgage company just kind of gives you permission to not pay for a short period of time. They're not going to consider the loan in default or not going to accelerate it or anything. But then that money still has to be paid, and so people have to come up with a solution. A repayment plan is where you might be paying your normal monthly mortgage plus they take whatever's past due and divide it up usually over a year or two, and you're paying that additional amount over time. A loan modification is where they just change the terms of the loan. They may make it change the length of it. It's now a 30-year or 40-year loan. They may change the interest rate or something like that to hopefully make it more affordable, or at least to scoop back in what was past due so that you're starting from scratch again. And then these deferred balance or partial claims, these are loans where they say, okay, you're behind X amount. We're just going to pull that out, make it its own little mortgage, and file a lien, and then that will come due at the end of the rest of the mortgage. And that's something, again, that people can somehow forget about, understandably, or think they've been paying it off. Heirs inherit the home and don't know it existed. So those can be there, but that is a very powerful solution in the moment. If you're about to lose your home, you can now save up over time. And the FHA ones are interest-free, so that's good. And then there are additional loss mitigation options for reverse mortgages, which we'll also talk a little bit about. Okay. And we're going to have a spotlight here on heir property because we encounter this a lot. A lot of times people are coming to us because their parent or whomever originally owned the home passed away, or something like that happened, and now they don't know what to do, or the mortgage company won't talk with them. Most commonly, again, this happens when the borrower passes away. We see it in divorce cases as well, but basically the borrower is the one who had a contract with the mortgage company. The borrower is the one who was allowed to talk with the mortgage company, and so now the mortgage company doesn't know who the heir is and needs some ability to talk with them. The key term or the term of art is called successor in interest, and you have to prove that you qualify for that. So you have to either show that you have title, maybe you've probated the borrower's will or done an affidavit of heirship or something like that, or if it's a divorce, you have a divorce decree, what have you. And the document has to be reasonable in the light of the laws of the relevant jurisdictions. What does that mean? Usually, the first thing they're going to do is say, we need you to probate the estate. Servicers also often serve loans in multiple states all throughout the country, and every state has different rules, so they kind of use generic terms that might be recognized by everyone. But if they say you have to file a lawsuit and do a probate lawsuit, that may not be the case in your situation. That's the time to talk with a lawyer, what have you. There may be options for doing paperwork like affidavits of heirship to prove that you have a title interest so that you can get it done more quickly. Um, but that's something to keep in mind. You do have to prove that you have a title interest. So here are typical problems that successors find. They can't communicate with the loan servicer. They're not receiving monthly statements or notice letters. The borrower had things going to a PO box, and you don't have access to the PO box, and now you're not getting anything in the mail at all. They're not the person who's named on the homeowner's insurance. They shut down the website, so you can't access the website. If you need to engage in loss mitigation, you inherited this home, you can afford a mortgage, but just not the full amount that the borrower was paying. You need to modify it. They won't work with you. Um, Sometimes the servicer requires an ex-spouse to sign off on paperwork when really they're not, they shouldn't have to, or there are certain circumstances where they shouldn't. Sometimes they do. Um, but sometimes the servicer asks for unreasonable documentation. Again, they're being told you need to file a probate lawsuit, and maybe you don't know that that's actually not a requirement. And just plain in confusion, servicers are normally very good about wanting to work with somebody, and they will send a letter saying, hey, you need this, that, and the other paperwork. But sometimes those letters are confusing. Or again, they're going to the borrower's PO box that you don't even have access to. And again, successors in interests are heir property owners generally. And heir property is created when prior generations of homeowners don't probate the estate or do some kind of uh, process to show who owns the home. So they just kind of say the whole family knows that this person has always lived in the home and the mom would have wanted them to have the house, and they just continue to stay there. But as far as the clerk's records are concerned, as far as the public is concerned, it looks as if the borrower who's now deceased is the owner. That's the last deed on the property. Um, if there isn't a will, or if the family doesn't do anything with the will within 4 years, title might pass under what's called intestate succession, which is basically Texas's will for you. Texas has laws in place to determine who gets someone's stuff when they pass away if that person did not leave a will. And the laws are unique, depends on who is in the family. Many times the multiple people inherit. So let's say this person who owned the home and passed away had 4 children. Now all 4 of them own an equal undivided share in the property, meaning they all own it together. And they don't just one gets the kitchen and one gets the bathroom or something like that. They have to agree and share everything. And sometimes it's created when there actually is a will, but the person left property to multiple people. You may hear community, talking about this as tangled title. Again, as we talked about, problems can be the successor in interest. They can't talk to the mortgage company. Other things they can't agree as the heirs. Some want to sell and some want to stay in the home. They can't get a home equity loan or government assistance to make home repairs because they don't have title clear. It can result in tax foreclosure. There are rights to get your homestead exemptions, to get a tax deferral if you qualify, but the heir property owners might not know about that. And so when the person passes away, you're supposed to report it to the appraisal district, but eventually they'll find out either way, remove the exemptions, deferral, taxes go up, and now it's hard to afford. And AMOS has great presentations about property taxes. There was one yesterday, and they have additional ones in addition to our upcoming tax foreclosure presentations. So here are some tools. So mortgage servicers are, of course, human or run by humans. So sometimes, you have rights, and for whatever reason you're having trouble accessing them. So the first thing we might suggest is we just escalating, complaining. The mortgage servicer should be helping me and they're not. Here are some numbers that you can call if a mortgage company is giving you difficulties. Fannie Mae, Freddie Mac, and FHA have servicing numbers that you can call. You can also call the Attorney General's Consumer Protection, Texas Office of Consumer Credit Commissioner, or the Consumer Finance Protection Bureau. In addition, you have the right to write. You have the right to write a specific type of letter to your mortgage company that they're actually legally required to look at. So a lot of transactions with servicing, it's done over the phone. You're having difficulties, so you call your mortgage servicer. They tell you some stuff, but it can be hard to prove or keep track of. The law actually requires them to respond if you send a specific type of letter with specific requirements. It's called a request for information or notice of error. Request for information letter. Again, you're asking for information. Tell me what my options are for loss mitigation. Tell me how much is owed on the loan. Tell me what I have to do to become a successor in interest. They have to at least respond if they think you might be in error to that question. Notice of error is when you're notifying them that something's wrong. I paid you and you didn't count it on my ledger, something like that. You might hear the term qualified written request. That's what QWR is. You must send it to the correct address. So they will have in the fine print somewhere, often on the website, at least on your mortgage statement, to send a QWR, ROI, NOE, what have you, they call it, send it to this address. And it may or may not be the same address that you're getting your statements from. So you do have to send it there. And you have to put enough information on it that they can identify you as, which loan. So put your loan number, your address, the name of the borrower, enough stuff so that they can find you and know what letter this goes with. The one thing though is it does take a long time to respond. So it's good because it's got legal backing and rights. The challenge is that it takes a long time. So they have 30 days to respond, not counting weekends and holidays, and they can ask for a 15-day extension as well. So now you're looking into 45 days to 2 months. So trying to resolve things informally over the phone to start while also sending a letter is normally a good approach. And I didn't go over many details about how to write the letter, but if you go to lonestarlegal.org, and select our resource library, we can help you prepare a letter. You click on the foreclosure. When you click on resource library, it'll give you a list of things. You select foreclosure, and then there'll be, what do you do if you can't pay your mortgage? And you can go through that tool to help you prepare a letter to your mortgage company. And then briefly, now we're moving into just specialized types of loans. So what are home equity loans and HELOCs? So home equity, what is that? That is the amount of money that your property is worth minus any existing mortgage and other liens like property taxes. So if your home, for example, is worth $100,000 and you have a $75,000 mortgage and no other liens, then you have $25,000 of home equity. And that's what I was explaining earlier about the foreclosure. If the $75,000 is owed on the mortgage company is only going to start taking foreclosure bids at that amount, and that $25,000 may not get paid if nobody at the foreclosure sale pays more than the 75. So your best bet is to try and tap into that by selling on the open market if needed. But that home equity, that leftover amount, is what these home equity loans are allowing you to tap into. So a regular home equity loan, again, allows you to borrow money using the equity in your home as collateral. So they know that you have a home, it's worth a certain amount, and you're getting a loan based on that. It usually has a fixed interest rate, so you know you're paying exactly 6% or whatever throughout the whole loan. You can receive a sum up front and pay it back in monthly installments, just like a regular mortgage. You can use that money for home repair or other needs. And if you have a mortgage already, this would be yet another mortgage that you're paying. But just like any other mortgage, if you default on a home equity loan, the mortgage company can foreclose. And then HELOCs, home equity lines of credit, are another type of loan to borrow against your equity in your home. They're structured a little bit different. They have a draw period in the beginning where you can take a little and take a little more, borrowing period, and you can make minimum payments. After that period ends, you can't borrow any more money and you enter into repayment only. Um, but sometimes the repayment period is shorter than the amount of money that's been taken out. And so you end up with owing a big amount all at once. So that can be a challenge. You might have to take out yet another loan to pay that off. And also, it often has adjustable interest rates, meaning you really don't know how much interest you're going to pay with 100% certainty. And again, this type of loan can also foreclose. So now on to the special type of loan called a reverse mortgage. So a reverse mortgage, you might hear the term home equity conversion mortgage. It's a special type of home equity loan. And again, more commonly, it's just called a reverse mortgage. You have to be age 62 or older and live in the home as your primary residence. So it's only for your homestead. Um, there's actually no personal liability to pay the loan. The security is the house. So basically, with the mortgage company, you're saying, I'm not going to pay you every month for what I owe you. You're just going to know that at the end of this loan, if it's not paid off, you can foreclose to get the money back. That's basically the arrangement. But because you're not making monthly mortgage payments, you're not paying towards the property taxes, HOAs, and homeowners insurance monthly like you usually would be. And HOAs are often not paid to the mortgage company anyway, but taxes and insurance generally are. So you must have home equity in the home. The home must have a certain value to it in order to get a reverse mortgage. And you have to have it in good maintenance because that's the mortgage company's security, knowing that you have a home in good maintenance that they could foreclose on if you don't pay off the loan someday or if you're not paying the taxes or what have you. So the home itself has to qualify in addition to the person's age and such. And more reverse mortgages, the amount that's owed over time raises because you're not making payments. So over time, there's a fee for all the servicing that's done, sending you statements and so forth. There's interest and fees and all that. And over time, the amount you owe increases. And there are some AMOS presentations specifically on reverse mortgages with these details. The loan balance someday may even grow higher than the value of the house. And in that case, HUD again is the investor and it will often take over the loan, but now you're paying, you have a servicing transfer and you're paying a different entity. Or a different entity is keeping track of you. And that entity is who you would be working with if you had to do any loss mitigation. So whichever servicer, you still have a servicer for these reverse mortgages, even though you're not making monthly payments. The loan balance becomes due when you sell the home, which is true of any mortgage. If the borrower no longer occupies the home for more than 12 months without the servicer's permission. So again, this has to be your primary residence. You actually have an annual certification to sign and turn in that you're still living in the home. And if for some reason you have to leave for some period of time, you actually have to get the servicer's permission. The loan becomes due when the last surviving borrower dies. So if it's a couple, a husband and wife, and the wife passes first, the husband can stay in the home, although there's often paperwork to do, but they can stay in the home. But once that person passes away, ultimately the home can be foreclosed. And then, of course, during the life of the loan, during the borrower's life, if they default by not doing something like paying taxes and insurance, the loan can be foreclosed. Now, here comes the issue for heir property owners that we talked about earlier. Um, the only person that can stay in the house with the reverse mortgage is a surviving spouse. They don't want the spouse to be unhoused. But once the spouse is gone, once the borrower and any spouse is gone, then the heirs, you can leave the home to them, but they inherit it with this mortgage on it. And unlike the other types of mortgages, you can't just take over the reverse mortgage. Part of the terms of the reverse mortgage contract is once the borrower and spouse are deceased, they can foreclose. So the servicer has to identify the heirs, try to work with them, give them some time, but after that, they can ultimately foreclose. You can't just take over the mortgage as an heir. So what are some benefits? Why would somebody enter into this arrangement? Well, of course, you can get, monthly payments to you on behalf of your as a result of having this loan, or a big lump sum or a line of credit to tap into. You can use it for, home repairs or pay off debts or what have you. You can access emergency funds if something is needed. And another borrower benefit, again, you're not paying monthly. And you get to live in the home while you're accessing its equity rather than selling it to get the equity. But it works best if you know that either your heirs can pay off the loan when the time comes, or that you don't intend to leave the property to any heirs. So there's risks. First of all, it can be difficult to get the reverse mortgage. You have to both be 62 if there are spouses, and if it's one person, they have to be 62. And then the property has to be in good condition. There can't be existing liens. You can't defer your property taxes. So again, AMOS has other presentations, but if you're disabled or once you turn 65, you have the right to put off the deadline for paying your taxes. You can't do that with any kind of mortgage, but if you have your home paid free and clear and then you add a reverse mortgage to it, now you no longer have the right. You've contracted away your right to defer the taxes. And as we've said a bunch of times, you could still be foreclosed for not paying the taxes or maintaining the home or leaving the home. Again, more risk. You can't leave it to your heirs without them paying it off. Fees keep accruing, and the loan balance can actually be more than the value of the home someday. So even if your heirs sell, they're not really getting any benefit, any equity out of it. Reverse mortgage defaults and loan servicing. So we talked about defaults and loss mitigation for regular, so to speak, loans. But reverse mortgages also have some of their own rules. The majority of reverse mortgages are FHA backed, meaning the FHA, Federal Housing Authority, insures them, and they have federal regulations for them. There are some private companies that offer reverse mortgages, and not too many of them, but there are some. But today's presentation doesn't cover those options. We're talking strictly about the main one, which is FHA. So if the property, you might ask, what happens if I don't pay my taxes and insurance? It's not that they go unpaid at all. It's that the mortgage servicer, one of the jobs they do is they check the tax records and they call your insurance and so forth. They will pay these things for you. So if they find that you haven't paid your taxes, they don't want to risk having the house be foreclosed on and them losing their collateral. So they will go ahead and pay the taxes. And then you owe them the tax money. Same with homeowners insurance. Also, if your homeowners insurance lapses, they will get homeowners insurance for you, which usually doesn't even cover just them. It doesn't cover much, but they will get it. It's expensive, and then they'll charge you for it. So now you owe the mortgage company money. They are allowed to offer you some options now that you have to pay them back for the taxes and insurance. Um, First thing is they'll review your income and expenses to see if you qualify for a repayment plan. And you have you should have up to 60 um, equal monthly payments up to 60 months. So they can divide out the amount that you owe if you qualify for this repayment plan. We're hoping it's more, but at this point it's at 60 months or 5 years. Um, Generally, repayment plans are only allowed once, although that might change. New guidance will allow successive repayment plans as well. And for arrears or past due for over 5,000, it used to be even lower than that. But keep in plan in mind, not everybody will qualify. You even can prove to HUD that you have a reasonable expectation that you should qualify, but at the end, they may just not feel that your income qualifies to be able to guarantee that you could pay off the arrears. There's a few other options. One thing is informal delay. You can actually just, they can agree, fine, you can't pay it off. We're just going to kind of informally give you some time to pay it whenever you have the ability, as long as you say you're trying. This usually works only for relatively low amounts, but you can go over 5,000. Borrowers have the right to reinstate after acceleration. So what does that mean? Maybe you haven't paid the servicing, the arrears taxes or insurance, and they've sent you all these letters, and now they've accelerated, made the whole loan due, and you're fortunate that your family and everything pulls together enough to pay. You can pay that amount then, and once every 2 years, the servicer has to accept that money and de-accelerate the loan. But keep in mind, by the time you've gotten to that point, there's attorney fees and all of that stuff. There's extra rules for somebody who's 80 and older, and this is interesting. The youngest borrower must be at least 80. So if you have a borrower who's 80 and a borrower who's a spouse who's 75, you have to wait until they both reach age 80. But if they're having a critical medical issue, that would be made worse if they were foreclosed upon, they can actually get a doctor letter saying that they have a critical need and they shouldn't be foreclosed on. In fact, they can even turn in lots of medical records or something to show that there's this problem. And then the mortgage servicer is supposed to treat this basically as an informal delay or a formal delay, called an at-risk extension. They're extending the amount of time that you owe the money to pay back the money. Usually you had to recertify it every year. You should be able to have it permanently now, but be expecting them to at least call you and say, please confirm that you still have this condition. So that means if you're 80 or older and you still owe the taxes or insurance, you should be able to get this. But they will require you to attempt a payment plan first. So, or they will assess someone for a payment plan. So they don't go straight to the at-risk extension. And then I'll just do this briefly. Mortgagee optional election, basically, if the loan was originated before August 4, 2014, there are additional options because they didn't have those fail safes before where both spouses had to be on the loan. So sometimes the loan would be only in one spouse's name. They passed away, meaning the last borrower passed, and now the remaining spouse can be foreclosed on. So this is a process where the surviving spouse can apply to be recognized as if they were a borrower so that they won't be foreclosed. And so here's a little image. Options for non-spouse heirs. So as we've talked about, if somebody inherits the home who's not a spouse, then they have to pay off the mortgage or sell the home, or it will be foreclosed. But they are given some extra leeway. So they're given up to 2 90-day periods, so 180 days from the date of the death of the borrower to try to resolve the issue before the servicer can foreclose. So again, some options are paying off the loan, refinancing the loan. So maybe they don't have the cash themselves, but they have the ability to get a different loan to pay off this one. Something that heirs deal with, though, is maybe they have not cleared title yet. So this person has passed away. They're willing to sell or they want to get a new loan, but now they have to do some kind of probate or some kind of family agreement to be able to do that. And if another heir is 62 or older themselves, and if the house qualifies, they may be able to get another reverse mortgage to pay that one out. Another option is a deed in lieu. Basically, they can just give the property back, but again, selling it might be your best bet if there's any equity left in it. Another thing is if at worst you can sell the home, you only have to sell it for 95% of the appraised value. Basically, what that means is you've sold it and maybe you haven't paid off the whole amount that's due, but at least they can't come back and charge you the estate for it. You can ask for an extension of those two 90-day periods, but it's not guaranteed. You usually have to provide like a listing agreement, something to show that you're really committed to actually trying to sell and the property is officially on the market. And they may offer cash for keys up to $7,500 or up to $5,000 for probate costs to heirs. If you're trying to sell or give back the property. So actually, they may even help with some of the cost of that. But the first thing you would have to do is prove you are a successor in interest, which we talked about earlier. So that's to tap into all of this, well, you have to prove that you're a successor in interest. And here are the summary of options. You can go to HUD.gov and search for non-spouse heirs, and then they have a nice little flyer that goes through all of this. And then what if you don't qualify for any of these options to save your home? So whether it's a reverse mortgage, a traditional mortgage, a home equity loan, or what have you, what you may or may not qualify for loss mitigation. So one option might be to see how much is past due or how much is owed on the loan and see if you can refinance it, get a different loan, maybe with a better interest rate, or maybe you qualify for a reverse mortgage. So go ahead and buy that one out. So that may be one option. You might be able to file bankruptcy. You want to talk with a bankruptcy attorney. You actually, believe it or not, in order to keep property in a bankruptcy, you have to have money. So you have to be able to prove that you could pay this off, or you could, pay off the arrears in 3 to 5 years or what have you. So talk with an attorney to see if you qualify. Again, you could sell the property to try and at least get the equity. You can do what's called a short sale or deed in lieu, trying to just give the property back and not owe any money. The servicer may offer limited relocation assistance. And then finally, if the home is foreclosed, a new buyer must file an eviction lawsuit to remove you from the home. And then HUD housing counselors, HUD.gov. Again, housing counselors are great. They're certified through HUD. They have, lots of knowledge and experience to help you try and read through papers and come up with ideas. And we have several here in Houston. Okay, and I am ready to move on to Sam again.
Okay, okay.
Okay,
I'm
thank you,
good.
Sam.
Where am I? Uh-oh. Okay, give me 1 second. I don't know why I did that.
And if not, let me know if
Oh,
you
my
need me
mouse.
to do it.
My mouse is acting funky.
Okay.
Okay.
Oh, you're sharing your desktop.
Yeah, because I have it here. Okay.
Okay.
No current slide. And then we're going to swap. Perfect. Okay, so let me go back 1 slide. Okay, so we're good. You can see my screen. Okay, so I'm going to talk about contract for deeds, or they're also called, you may also know them as executory contracts. So, what are executory contracts? An executory contract is a long-term agreement to buy real estate or real property. And again, you may also hear it called a contract for deed, a land sale contract, or an installment land contract. While the names may be different, they're generally describing the same type of transaction. And unlike a traditional home purchase with a mortgage, with an executory contract, I'm going to call it a contract for deed just because it's easier for me to say. Um, a contract for deed, in a contract for deed transaction, the buyer does not receive the deed or legal title to the property when the agreement or contract is signed. Instead, the seller keeps the legal title throughout the life of the contract. The buyer does usually makes an initial down payment and then agrees to make monthly or other periodic payments over time. Under Texas law, though, and contract for deed generally refers to a contract that extends for 100 or 80 days or longer, which is why these agreements are often long-term commitments. And then only after the buyer has made all of the required payments and fulfilled the terms of the contract does the seller transfer the deed to the buyer. So, unlike a traditional mortgage, you don't get the title or the deed in your name until after you have finished making all of your payments, and the deed and title remains in the seller's names. So that is one of the biggest differences between a contract for deed and a traditional owner financing contract. With an executory or a contract for deed, the buyer you can live in the home and make payments for years without actually holding legal title. That distinction is important because, again, not having legal title can affect your rights if problems arise, such as payment disputes, property issues, or risk of losing the home if the contract is terminated. So, who uses contract for deeds? Well, these contracts are most often used by people who have trouble qualifying for a traditional mortgage. Now, this doesn't necessarily mean that they've made poor financial decisions. It just simply means that they don't meet a bank's lending requirements at that particular moment. For example, someone may have a low credit score or a recent bankruptcy or other issue that makes it difficult to get approved for financing through a bank or credit union. Other people may have little or inconsistent employment history, and they may have recently entered the workforce or be self-employed, work seasonal jobs, or have gaps in their employment history that make traditional mortgage lenders hesitant to approve a loan. Some buyers also have a high debt to income ratio. So even if they are making payments on time, having too much existing debt compared to their income can prevent you from qualifying for a traditional mortgage. Another common situation that we see with contract for deeds is someone who recently changed jobs. Even if you're now making more in income at your new job, traditional lenders often want to see stable employment before approving a home loan. And then finally, many buyers simply let me catch my breath, don't have enough money for a large down payment that these traditional mortgage companies are asking for. Uh, they don't have closing costs or other upfront expenses that come, again, with the traditional mortgage. Contract for deeds often require less money upfront, making them seem like an accessible option. I've seen some where, you use your tax refund to do your down payment and then enter into this contract for deed. So it's, kind of cheaper on the front end compared to a traditional mortgage. And then for many families, an executory contract or contract for deed appears to be the only path to home ownership. And unfortunately, while these agreements can provide an opportunity for you to buy a home, they also come with significant risk and fewer legal protections than a traditional mortgage would. That's why it's important for you to understand both the benefits and the potential pitfalls before entering into a contract for deed. So, what is so important about these contracts? Well, historically, these contracts have been potentially predatory. While not every contract for deed is unfair, they have often been used in ways that leave buyers with very little protection. Our biggest concern is that the buyer can spend years making payments, paying the property taxes, maintaining the home, adding additions. Um, and yet you still don't own the property because the seller keeps, again, the legal title in their name until you have finished paying out your contract. So recognizing these problems, the Texas legislature strengthened the law by adding significant consumer protections for you. These laws are designed to increase transparency, require important disclosures, and give buyers greater rights and remedies when the sellers fail to comply with the law. So, let's go to the next slide. So, in Texas, the primary law covering contract for deeds is found in our Texas Property Code, Chapter 5, Subchapter D. This section of the property code was created to protect consumers and establish rules that sellers must follow when using these types of contracts. The statute generally applies when somebody enters a contract for deed to purchase residential property that will be used as a buyer's home. So not commercial property, not my second home. It's just going to be my homestead where I live most of my time. So hold on. I lost my train of thought. Okay. And the contract will also take more than 180 days to complete. And within that 180-day requirement, it's important because shorter agreements generally aren't treated the same way under this particular law. The legislature recognized that long-term contracts generally aren't treated this. Long-term contracts create greater risks for buyers and therefore require additional protection because you have 180 days minimum to pay off this contract and you've invested all that money in this long period of time and you want to protect yourself so you're not losing your property. However, not every consumer protection in subchapter D applies to those agreements, so it's important that you review the specific facts of your case and then consult your financial advisor or attorney. There are also important exceptions with this law. For example, again, they do not generally apply to transactions involving governmental entities or contracts between certain family members. These situations are treated differently under the law, so you'll notice that the reference to property measuring 1 acre or less, under that statute, the property of 1 acre or less is presumed to be residential, which means this is where you live. And that helps determine whether your protections fall under subchapter D. So, and finally, one of the most important things to remember here with these contract for deeds is that this property code is that this chapter doesn't just tell sellers what they must do. It also provides you, the buyer, with legal remedies or solutions if those requirements by the seller are not met. If the seller happens to violate the statute, then you may have the right to recover statutory damages, which can be money, actual damages in some circumstances, attorney fees, or other relief provided by the law. So, risks to buyers who use executory contracts or contracts for deeds. In this slide and the next one, we're going to highlight some of our biggest risks that us as buyers face when purchasing a home through a contract for deed. The first and most important thing to remember is that traditionally, with contract for deeds, and you're going to hear me say this over and over again because it's real important that you remember this. The buyer, you, do not become legal owner of the property until every payment required by the contract has been made. Even though you may have lived in the home for years, paid thousands of dollars towards the purchase price, paid your property taxes, your insurance, again, made repairs, the seller still holds legal title, which means it's still technically their home. But because of changes in Texas law, you now have some opportunities to obtain legal title before the contract is completely paid off. So it's just like some protections while you're still living in it and you're still paying the home off. However, they're not automatic, which means you do have to do a little bit of legwork if your seller is not doing those. You have to know your rights, and in a lot of cases, you have to take action to enforce them. If you don't, then you risk your chance of ever fully benefiting from these protections. One of the other risks that buyers have is that buyers have limited control over the property while they're under the contract. And since you don't hold legal title just yet, you won't be able to sell the property if you decide you want to go bigger, or, you just want to sell. You won't be able to refinance or use it as a collateral loan for something else. Those limitations become greater if the contract for deed is never recorded in the county property records. And so what do you mean by it being recorded in the county records, you're asking me? So recording your contract for deed is important because it puts the public on notice that you have an interest in the property. And so what that means is like you're telling you record your contract in the county where the county clerk's office where you reside, where the property is, and you're telling the world, hey, I may not own this home, but I'm purchasing it and I have an interest in the property, which we'll talk about a little more of why that's important too. But okay, let me get back on track. Well, without a recorded contract, if anyone goes searching for the title, they may have no idea that you are, in fact, an interested owner in the property. So if I'm buying the home from the person who sold you the home and my title person goes and does title research, they're not going to see that you have an interest in the home and I can buy the home from the seller without you ever knowing. And then one day I'm going to show up at your house and say, hey, this is mine. What are you doing here? And then we both have to go back to court. So it's very important that you record your contract. So, and the good news is that typically the seller is supposed to record the contract, but sometimes they don't. And you have the right to not rely on the seller to record the contract. If the contract has been notarized, you can record it yourself with the county clerk. And even if it wasn't notarized, in the state of Texas, Texas law provides another option where you may be able to attach a signed notarized affidavit of facts to the contract and record both of those documents together. And then this helps protect your interest in the property and it creates a public record of said agreement or your contract. So if this is the avenue that you take to buy your home, ensure that the seller is recording the contract in your county clerk's records. And if not, you have a right to do so as well. And your seller can't stop you from doing it at all. So some other risks for people who use this contract for deed option. Jesus. Okay, again, you don't have clear title, even though you're supposed to, or maybe the seller may not have clear title, even though that they are supposed to. So I've seen in some cases here where someone bought a home from a personal seller. And then it turns out that that seller didn't even own the home. And so now our buyer is without a home and without all their money that they've invested into their property, whether it's mortgage payments, repairs, property taxes, insurance, and all of that good stuff. So these are, you have to ensure that there's clear title when you're entering into one of these contracts. You also risk losing the property and any money that you've invested towards the property if you default, which means if you don't make a payment or you don't follow the rules that your seller has set forth. The seller can cancel the contract and reclaim the property, keep all your money, and benefit from any improvements that you have made already. Another risk is that the seller can continue to refinance the mortgage, take out another mortgage, have a lien placed on the home, even though that they're not supposed to. There's a big risk that they could be doing that. So you don't even know while you're paying down your mortgage to this person, they've already encumbered a second mortgage for that property. So by the time you're done paying, who's to say they don't stop paying their second mortgage or their other mortgage? Maybe it's a first mortgage because they own the home right out. Um, and then you're getting letters to the property that's saying your home is being foreclosed on, and you don't know why because you're not the person those letters are addressed to, and your contract to buy that home is with the person who took the mortgage out. So it's very important that you do your title clearing processes before you enter into one of these contracts. Another risk is that your seller may try to evict you rather than foreclose. Um, and so, okay, so here are some key buyer protections to protect you when you're entering into an executory contract or contract for deed agreement. One of your strongest protections is the right to convert your executory contract. Although the law requires a seller, again, to record it, it doesn't always happen. So then you're not left without options, but it makes it more harder for you to establish ownership. So under Texas Property Code 5.081, you have an absolute right to convert the contract for deed into a transaction where legal title is transferred to you, the buyer. To exercise this right, you must first tender the remaining balance due under the contract. And once that happens, then the seller cannot refuse to complete the transaction or charge additional fees or penalties simply because they want to convert, because you want to convert the contract. And so what converting the contract means is that you want to actually change the ownership to your name because you fulfilled your part of the contract, but the seller doesn't. I've seen cases where the seller, after the buyer has remitted all of their payments and paid off the balance and everything was right, where the seller comes back and says, well, you need to pay me so much money to release the lien, because that's what they have on the property if they've recorded the contract, to release the lien and grant you ownership. And that's just not gonna fly here in Texas. So it's important that you know that they're not allowed to do that. They can't charge you additional fees or anything like that. So again, this protection exists whether or not your original contract for deed was ever recorded. So even if the seller didn't record it, even if you didn't record it, if you fulfilled your agreements, then you can take that contract, come to Lone Star Legal Aid if you qualify for our services, or hire your own private attorney to help secure your interest in that property and your actual title because you fulfilled everything. Another important protection is your right to request the contract balance and trustee information. A lot of times, I've seen where these buyers don't know what their balance is because they've never been offered an accounting statement. And then when they've asked the seller for these statements, they get the runaround or, yeah, I'll send it to you, and they never get it. So they don't actually know what they owe, what the balance is, and what they paid so far. So it's very important that when you're committed to one of these contracts, you keep your own personal records for your accounting history. Keep your receipts. If you're paying by money order, take pictures, email them to yourself in a little subfolder in your email that says house receipts or something. If you made payments via Zelle or a wire transfer, make a diary, take copies, forward those receipts to your email. And I say forward them to your email, and I know not everybody does the whole email thing, but we live in Houston, Texas, and we flood all the time. And so we lose a lot of our important documents. So it's important that you have backups of these. Um, so again, sometimes you don't know how much you owe because maybe they even didn't secure accurate records of what you paid as well. Again, Texas law gives you the right to request a written statement showing the remaining balance owed under the contract. If your contract allows for foreclosure, then you may also request the name and address of the trustee designated to conduct that foreclosure. The law also places deadlines on the seller. For example, the seller must respond within 10 days of your request for an accounting statement. If they don't, then you may determine the amount they believe is that you believe is owed, and if applicable, then you can also designate a trustee. If the seller somehow disagrees with your accounting calculation, then they have 20 days to object in writing, and that objection may be supported by business records that the seller has properly maintained. And I'm going to say properly maintained is a key word here. So these rules are important because they prevent sellers from withholding information or making it difficult for you to determine what you owe. And it also encourages an accurate record keeping policy and provides you with a clear process for resolving disputes between you and the buyer about how much you owe, what you paid, and etc. So also under Texas Property Code 5.084, if the seller is liable to you because they violated the property code, then you may also be able to deduct that specific amount from what they still owe under, from what you still owe under the contract for deed. An example for that is that if a seller fails to provide required disclosures, and doesn't comply with statutory requirements or is otherwise liable for damages under the law, then you may not have to pay the full contract balance without accounting for those damages. So one important feature of this particular protection is that the buyer does not have to file a lawsuit first in order to claim the offset. The statute allows you to reduce that amount owed by the amount the seller legally owes them. So of course, if the seller disputes your deduction, then you may have to consult a lawyer and get the courts involved. The second protection is that you have a right to cancel the contract, which is very important, but it's also very specific. So in Texas, the law gives you, the buyer, a 14-day cooling off period after you sign your contract. So what that means is that during those 14 days, you may cancel the contract for any reason at all simply by providing the seller with the required notice. You don't need to have to prove to the seller that they did anything wrong. Maybe you changed your mind or discovered that there were problems within the property. I see, or you found financing elsewhere for a traditional mortgage, or you just simply realized that the contract was not a good contract that benefited you the most. So you can cancel it for any reason. I've also seen some of these homes. Actually, I read an article where this investor in Houston was selling all these contract for deed homes to people as is, which means you buy it and then you discover that the plumbing doesn't work. You can't go back to them and sue them because it didn't work. You bought it as is. But you have that 14-day cooling off period where you can decide, you know what, the plumbing doesn't work, so I'm out. I don't want to have any interest in it. It's going to be more of a headache than it is for me to own a home. So you want to opt out. Whatever reason, it doesn't matter. The law gives you this opportunity to walk away without having to justify your decision. This protection also recognizes that many buyers are making one of the biggest financial decisions of your life and you should have a short period to reconsider after reviewing the contract more carefully. I know a lot of us are anxious I'm going to own my home, my first home, and this is the only way that I could do it. But it's very important that you remember that you have these protections. And if you decide within 14 days that it's not beneficial for you because this is your home, this is where you're going to spend the rest of your life potentially, remember you have 14 days to decide if this is for you or if you simply want to walk away. So how do we record our contract for deeds if our seller has not? Again, this is the simplest but most important way that you can protect your interest in that property. You have to record your contract for deed or ensure that the seller did. As we discussed previously, Texas law requires the seller to record the contract, but unfortunately, they don't always do that. If they fail to do so, you don't have to accept that. You have a right to record the contract yourself, as we discussed earlier. This serves as an important purpose. It again puts the public on notice that you have an interest in a property. That means if somebody searches the county records, which we do a lot here in our line of work, such as another buyer, lender, or a title company, they can see that the contract exists and they see that you have an interest in that property. It helps protect you against future disputes involving the property. And so it protects your ownership rights. So how can I record my own contract if my seller doesn't? Well, you can go to the county clerk's office because they must receive that document, your contract, and it has to meet the recording requirements. This means you have to have the original notarized contract, a certified copy, or you're asking, Samantha, what if we didn't notarize it? What if we just signed it in his office and whatnot? That's okay, because if it wasn't notarized, then you can, again, as I mentioned earlier, attach a properly executed affidavit that satisfies the recording requirements. And I'm going to tell you what goes on that affidavit in my next slide. So um, we'll get to that in a minute. So if your contract is notarized, you can file it in your county clerk's records. You can even do it online, I believe, or go to their office. If it's not, if it's not notarized, then you need your affidavit. This process is really straightforward. You take it again to the county clerk's office where the property is located. So I know we're in Harris County right now, but a lot of our clients are not. So we would advise them to take it to their county clerk's office where they live. File them in person, or you can submit them by mail if your county allows it. You can check online or call them. And then you will also need to pay the applicable fee, which is nominal. It's not a lot of money. So next, we're going to talk about this affidavit concerning executory contracts for the conveyance of real property. So this comes back to, what if I don't have the original notarized contract, or what if my contract is not notarized, but I still want to protect my interest by recording it? So, you can still record the contract, but you will need to attach, again, the affidavit concerning executory contract for the conveyance of real property document. So think of this affidavit as a sworn statement that tells the county clerk and anybody else looking for it what the document is and why it's being recorded. This affidavit also helps satisfy the recording requirements when the contract itself can't be recorded on its own. So the affidavit needs to include several pieces of information. Firstly, and importantly, it should identify who is making the affidavit. So it would be your name, or any other person signing it. It should also state that the attached contract is a true and correct copy of the original in accordance with Texas Property Code. Your affidavit should also identify the document as an executory contract for the conveyance of real property under Chapter 5 of the Texas Property Code. Next, it should include information that clearly identifies the property, including the legal description. I know a lot of us, they want your property address and legal description. Your property address and your legal description are two completely different things. So it has to have both. If you're not sure where to find your legal description, you could probably look on the contract for deed and it should be there. If not, you can go to your county clerk's office and pull up an old deed and get it from there, or your central appraisal district's office as well. It must also state whether it should also identify the parties. So the seller and yourself, it should have everybody's names on it and the state where it was recorded and the date that the state where it was signed and the contract, the date that the contract was signed. I'm sorry. It should also explain that the contract has not previously been recorded and that the buyer is recording it now as authorized by law. And finally, if the property is the buyer's homestead, that should also be stated in the affidavit because homestead property in Texas receives additional protections. So the goal of this affidavit is to create a public record of your interest in the property, even when the original notarized contract isn't available. And it can be an important tool for protecting your rights as a buyer while you continue making payments under this contract. So what happens if I default on my loan? Will I lose my home? Well, one of the biggest changes that Texas law made was they required the seller to follow specific procedures before they can take back the property from you. And one of the first steps is that they have to provide you with a written notice of default. And I know Ms. Lauren addressed that with regular mortgages. Contract or deeds kind of have to follow something similar, but it's not too similar. So they have to provide you with a written notice of default, and that notice must be sent by certified or registered mail and must include specific language required by our Texas Property Code. And the notice also gives you an opportunity to bring your account current before the seller can move forward with the next process. The length of the curing period depends on how much you have paid into your contract already, or whether the contract has been recorded again. So remember that. The amount of time that they give you to bring your account current depends on how much money you have already paid into your contract, and whether or not the contract has been recorded. And again, we're going to go back to that. You need to record your contract. Again, we stress that here because it is important, because this shows your interest in the property. And it's very important that you're forever showing your interest in your property that you're purchasing. If you have paid less than 40% of the purchase price, or you have made fewer than the equivalent of 48 monthly payments, then you are generally entitled to a 30-day curing period, which means if you have 30 days to bring your account current if you've paid less than 40% of the whole purchase price, or you've made fewer than the equivalent of 48 monthly payments. If you do not bring your account current during that time, and the contract has not been recorded, then the seller may be able to rescind the contract and proceed with an eviction, bypassing a foreclosure. In the past, this has allowed sellers to recover possession much more quickly than, again, going through a traditional foreclosure. However, once you have built up a greater ownership interest, the law provides additional protections. So if you've paid 40% or more of the purchase price, or the equivalent of 48 payments, or you have a recorded contract, regardless of the amount paid, then you have 60 days to bring your account current. If you still fail to bring your account current after those 60 days, then the seller generally can't simply cancel the contract and evict you. So instead, they must proceed through a foreclosure process and sell the buyer's interest at a foreclosure sale. And only after that foreclosure sale is complete can the person who has bought the home at foreclosure seek to evict you. Evict you if you don't voluntarily leave the property. The difference between the forfeiture and eviction versus foreclosure is one of the most important protections in Chapter 5. Our legislator recognized that buyers who have invested substantial money into the property, or those who have taken the important step of recording their contract, have earned greater legal protections before they can lose their home. So again, it's very important that you have your contract for deed at least minimum recorded because it provides you so much more protections than not. With that being said, I think I'm done. If you have any questions, I see like 2 in the chat. Um, okay, I guess that was it. But does anybody else have any questions?
I didn't see anything else in the chat. There were a couple, that just had private messages, but um, I think you all pretty much covered just about everything. So the floor is open in case anybody does have questions. Um, oh, that's your battery running low. I'm like, my computer's plugged in. Why is
It's
it
mine,
telling me
it's
it's
mine,
running
it's
low?
mine.
Okay. All right. But this is your opportunity to ask questions. You do have attorneys that are here that are present that are available to answer questions for you. I don't see any that are in the chat, and I don't have any questions that were emailed to me in advance. I don't see anything on social media either. Just to be on the safe side. Um, take that out of my ear because I'm hearing feedback. All right. Yep. Nope. I don't see anything in the chat. Um, for the person that was late, just know that that the session again is being recorded. Any available resources or links that were mentioned throughout the presentation will be included in an email that I send out to you all. So you'll have the opportunity to go back and watch the presentation again, or to forward it and share it with somebody else who also may be in need or experience some type of financial hardship that's trying to prevent their home from going into foreclosure, or at least wants to know, what the process is like, or where to go for some available resources. So do please share it. And I say this every presentation. Please be careful and do all of your available and your own research. Do not rely on a lot of social media platforms that do not have information specific to processes in accordance with the laws in the state of Texas. So know that the information that they do provide is relative to the laws for the state of Texas. There are a lot of blanket statements that are kind of out there that people post all over the place, and people automatically assume that the same process that happens in New York or California or wherever also is the same process as it happens here, and it's not. So do your research when you're online and looking looking to social media for information. So be diligent, do your own research. I want to give that disclaimer, but otherwise, Lauren, do you guys want to give your phone number again and your website again in case somebody is interested in applying for service with Lone Star?
Sure. Well, I could read it if you'd like, or I could get that screen up. But for temporary, 713-652-0077. Again, 713-652-0077. The website is lonestarlegal.org, lonestarlegal.org. And yeah, I just wanted to mention also with that recorded contract for deed, you can get your homestead exemptions. So if you haven't done that, keep that
Oh
in
wow,
mind.
I didn't know that.
Mhm. So,
Okay. Never ever ever. Even if you're doing a contract for deed, go through a title company. Don't purchase
yes.
property without going through a title company to verify that the person who's trying to sell you the house actually uh, owns the property,
Hmm.
and that way you'll know if there's an existing mortgage or existing liens and things like that against the property. Make sure that you go through a title company. If somebody gives you a hard time about going through a title company, then 9 times out of 10 they probably have something to hide. So just be leery. But that's the only thing. If somebody says, I don't want to go through a title company, I don't want to have to pay and blah 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 whatever, then yeah, protect your interest. Don't spend that kind of money on this kind of an investment to fall short, of a few dollars, to not really protect your interest, to make sure that you're protecting yourself against anything in the long run. Because at the end of the day, you can still walk away before you even put any money on any money out there, and you lose anything. So you have that opportunity. So just be careful. With that being said, on behalf of the partnership, the month of service collaboration, thank you all very much, Lauren and Samantha, the partners with Lone Star Legal Aid, for providing this information for us today. For the participants who are joining, for those who will be watching, again, we do record this session. It is broadcast live on our YouTube channels, as well as links being provided on our social media pages for you all to go back and watch in whatever format that you feel most comfortable at your leisure. But please reach out and look, listen, get the information that you need to protect your home, to protect your assets. So thank y'all very much for joining. We hope to see you guys back with us again in August. I think we start our series back over again. We're back to HOA foreclosures, I believe,
I
in
think
August.
so.
I think
It's
Yeah.
it's
it's
HOA.
HOA, yes.
Yeah, okay. And the foreclosure prevention series is done the fourth Thursday of every other month. So whatever that fourth Thursday would be, August 27th. August 27th would be the next foreclosure series session. So look for that information to come, along with any other information for other upcoming presentations that we may have in the month of August. Generally, we take the summer month or July off. Lots of people are traveling and taking vacations and what have you. So we don't usually do a presentation in July, but we hope to see you guys again in the future. You all have a wonderful remainder of your day. You all take care of yourselves, stay safe, and we'll see y'all next time.